Coming up today, extreme fear sets in the market. Is the AI trade over? Tesla falls 8%. Consumer confidence sinks to an 8-month low. Bitcoin loses 90,000. And can the godfather of AI save the day tomorrow? You don't want to miss this one, guys. Let's go. And welcome back, everybody. Still a bit of weakness in this market. But did they find support today? And will Nvidia give us that bounce tomorrow night when they report earnings? That's exactly what we're going to take a look at today as we scroll through key markets. Headlines and data out there to give you the full picture of where we're currently sitting. Russell 2000 did appear to find some sort of support here at this technical key level. And just looking at the S&P 500 index, as I said yesterday, thought we may come down and test that low from the 3rd of Feb. That was at 59.25. We actually got down to 59.08 today. And prior to close, my S&P 500 oscillator was in oversold territory. We had a little bit of a bite the dip there going into the close, but overall the market picture is still somewhat bearish. We can see that in the sector trends here. The markets that are uptrending, volatility, the defensive sectors, funny enough, high yield bonds and Japan and European stocks, along with a swift pullback in growth sectors and bond yields. And in fact, the Trump put in his second term may indeed be more so with bonds than stocks. Him and his Treasury Secretary, along with Elon Musk, really wanting to get long-dated bond yields down, help repay all the debt, along with finance further growth. Was a bit of a flight to safety there today, and long-dated Treasury bonds, TLT, jumping up almost 2%. But a good sign is credit markets aren't freezing up. In fact, we've got high-yield bonds not too far off 52-week highs, showing that bond investors aren't freaking out. And in fact, bond market volatility, looking at the MOVE index, still well below highs, and the VIX itself, still subdued here, couldn't close above 20. It's a bit of a key level. And the volatility term structure didn't go into backwardation either. And that's because what's happening right now isn't really a market-wide event. It's more a sharp and swift pullback underneath the surface in momentum growth stocks. Like we can see here in the spread of high beta stocks versus low volatility. Really sharp, swift pullback here. In fact, we've got the whole entire daily candle today underneath the lower buy-sell band here. Back in history, the last time we got that was on the 5th of August. And that's a pretty rare signal in a spread like this to have the entire candle underneath the lower buy-sell band. But looking back in history, this spread can have sharp sell-offs, kind of rotations in the market. And this one is another swift one. And I'm going to show you some patterns in some key leading stocks that, in addition to just how swift this pullback has been on pretty much just fears, no real change in the fundamentals, is leading me to believe it could indeed be a buying opportunity for those who believe in the underlying fundamental trends driving these stocks. And so here's a look at a few of them. Reddit, potentially finding support there today. My institutional buying indicator, it's been green for a few days, climbing to a healthy level of 64%, getting some reversal signals there. Bit of a swift pullback on Robinhood. We don't really have the reversal signals, but we are oversold in the DSI. Quite a lot of bullish seasonality coming in. DraftKings as well. Look at that sharp pullback. Palantir ticking a little lower today. Did just go into the oversold zone on the DSI. Another market leader, HIMS. Bit of a gap down after earnings here. Even though they did come in with a slight beat, we can just see the significant volatility of 45% in just a matter of days. Similar look in the nuclear trade. Oklo, really swift. 50% pullback in just a few weeks. And kind of an ETF that represents these type of stocks, the Innovator IBD 50, having a sharp pullback into a bit of a support zone and oversold here on my indicators. Also continuing to have a bit of a pullback of late, as we'd been thinking. Tesla did indeed take out these lows, actually briefly got under $300 a share there today, touched 297, but it too starting to look a bit technically oversold here. Minus 14 on the DSI, no reversal signals yet. Institutional buying almost green, has to go above 55%. Seasonality a bit mixed over the coming weeks, and just looking for the next level of support. May indeed be around this area, 265 up to about, say, 280 there. If we were to dip down there tomorrow or in the coming days, I'm going to look to be adding to my long-term position in the stock and picking up a few more shares. On the back of all these negative headlines we're getting on weak European car sales. Now the narrative is there's a lot of progressives over there that are boycotting the brand because of Elon Musk trying to clean up US government spending, which I'm sure there probably is a few people that are indeed doing that. However, if you look at the stats, European sales were already coming off before Trump even won the election and we even knew what Elon was going to do. Their economy's still struggling to even grow thanks to the same progressive ideologies. And the fact is, a lot of consumers all around the world are waiting for the new Juniper Model Y to come through. They're holding off. Dealerships are telling them, come back in March. Delivery's been pushed out. But again, this is the normal kind of volatility you see in quarter-to-quarter sales in any company. But of course, with a stock like Tesla and Elon, it just creates that wild volatility, the headlines. And other clowns come out of hiding, like former Tesla perma-bull Ross Gerber, who applied for a seat on the board of Tesla, was turned down. Elon didn't want to talk to him. And since Gerber already suffers from stage 5 TDS, once Elon got on there, he's had a bit of a meltdown And now he too goes on media all day trying to scare people out of the stock. However, you can listen to clowns like Ross Gerber. You may not even know he's got an ETF that he launched 4 years ago. Unfortunately for his investors, they're still underwater. And just comparing his performance to the S&P 500, it's literally off the charts here. That's just how bad he's underperformed the market. But anyway, that's just one of many who love to hate on Tesla and Elon. It's what makes the stock so juicy and gives it large swings. So hopefully we do come down to 270 over the coming days, and the optimists can pick up a few more shares on the cheap, as what's around the corner and the future for Tesla still looks as bright as it ever has done, in my opinion. However, of course, the big one tomorrow, Nvidia, the leader of this AI boom. Analysts expect them to come in with 84.5 cents in earnings per share. Stock has still been weak ever since the DeepSeek flush out we had, and zooming out, it's actually been trading sideways for over half a year now. It's been trendless, like we can see in my trend strength indicator here. When it's a negative, it indicates the market is going sideways. However, all markets oscillate between ranging and trending. They don't stay in one mode forever. And in fact, the longer we've been in one mode, the closer we are to switching. So the two big clouds hanging over the stock most recently, DeepSeek, ChatGPT clone coming out of China, apparently done with a lot less chips than what OpenAI did with theirs. However, again, just looking at what's actually happening versus the headlines and narrative, Chinese companies are ramping up orders for Nvidia's H20 artificial intelligence chip due to booming demand for DeepSeek's low-cost AI models. So like all technology, it gets cheaper, more efficient, and inevitably gets used more. And that kind of plays into the second fear with this stock. Is Nvidia's biggest customers, the mega cap tech, are they going to still keep spending big building out GPU farms? Well, listening to them all, they indeed are. It's still an arms race for who's got the most compute power. And I'd say back on the release of Grok 3 last week, XAI is now out in front with their 200,000 GPU cluster. Then we heard yesterday, apparently Microsoft is scaling back some data center leases. However, in an email from Microsoft to CNBC, Microsoft's plans to invest in AI infrastructure remain on track as we continue to grow at a record pace to meet customer demand. Microsoft is strongly refuting any change to their data center strategy, straight from the horse's mouth. But again, the market a little spooked here. Mega cap tech was soft today. In fact, it was the weakest group out of all the indices. But again, looking a bit technically oversold here. And this is what makes for fertile ground for a buy the dip and bounce. Getting a lot of peak negative sentiment. We actually got the fear and greed index now in the extreme fear zone. That's typically where we can find a bottom in the market. I'm seeing it all throughout my social media feeds, claiming the bear market's now started. Buffett's cashed in, ready for the crash. The AI trade is now unwinding. China's taken over. But seasonally speaking, isn't all that unusual to have a weak February, especially in a post-election year, and especially with all the headlines getting thrown at us. Exacerbating that today, the latest read on consumer confidence sinking to an 8-month low, just as this headline says, on worries about inflation and Trump tariffs. We don't even have both of those things here right yet. Apart from some isolated pockets like eggs and a few other things, the pace of inflation has still been holding around mid-high twos, but Americans are feeling a little more nervous about how things are playing out these days. Just keep in mind, the stock market doesn't represent all consumers. Just as we learnt yesterday from the Wall Street Journal, top 10% of consumers account for half of all consumer spending, and those same consumers own about 80% of the market. And that's why there can often be a big divergence between what's happening on Main Street and what's happening on Wall Street. And there's a look at a 10-year chart of consumer confidence. Definitely is down near the lower end of the range over the last couple of years. But just zooming out, still above COVID, still well above the GFC, and similar levels we've actually seen in prior bull markets. So again, it's soft for the here and now, but it's not like it's falling off a cliff. But we're all getting bombarded with these headlines. Tariffs are coming, and that's probably what's making the market a little nervous or just giving it room to sell off. A few bids being pulled. New taxes on Mexican and Canadian goods are set to hit next week. They initially were paused for 30 days to allow both countries to improve border security measures. But with the suspension period set to end, these tariffs are set to commence next week, March 4, unless potentially we get a deal by then. Also, reciprocal tariffs. Trump wants to place the same level of tariffs on other countries that they place on US goods coming into their countries. So again, the tariff headlines creating a bit of uncertainty, fear, and volatility in the markets. As we've been saying, this is going to go on for a little bit longer, but we do have yields pulling back, which can be interpreted as the market seeing weaker economic growth around the corner, maybe lower prices, lower inflation. However, it could also be the rhetoric coming from the new government, especially Treasury Secretary Scott Bessent, who had previously ridiculed Janet Yellen for using more short-term debt to fund the government, something we did here at Click Capital as well. She really blew out the maturity profile of US debt, didn't take advantage of low rates in COVID. But anyway, as we've been seeing of late, this new government didn't just talk about cutting federal spending, they're really looking to take the meat axe to it, which could very well lead to less issuance, which in theory, if there's less bonds being issued, the same level of demand, existing buyers will have to compete with each other more for the same debt, and that should drive yields lower. In addition to the market also potentially dialing back its inflation expectations. Just looking at the tip spread there, losing its 50-day for the first time in a few months. Because if the bond market was really worried about economic growth, I wouldn't expect to see high yield bonds, the riskiest of bonds, which are vulnerable in a recession as these high risk companies can default. I wouldn't expect them to rally up today and of late. In addition to the trueflation, latest reading being 2.33. Looking at millions of prices in the real economy, inflation's been tracking pretty good the last few months. And maybe this is also why interest rate traders now given about a 70% chance the Fed's going to cut come June, and we may even get another cut in September. Once again, is the market goosing the Fed into cutting rates before doing a massive buy the dip? Just going back last time we got that right here. Anybody remember that? In Q3 last year, 10-year getting absolutely clobbered, along with a little bit of a bump up in the unemployment rate. How the prevailing narrative, we're on the cusp of a recession. Fed needs to do an emergency 75 basis point cut. They did end up doing a 50 basis point cut on the 17th, marked the exact low in the 10-year, ripped up ever since then. And that sucked in a lot of people on that day to buy a TLT. At the top, one of them being popular financial YouTuber Meet Kevin, exposed just under half of his investors' fund to long bonds, caused a significant underperformance, and he's since closed down his ETF. Along with plenty of other people realizing just because the Fed's going to cut rates doesn't mean it's an easy trade just to buy bonds, as the bond market's a bit smarter than that and actually saw it coming, if not actually forcing Jay's hand. But again, the 10-year also getting a bit technically oversold. Moving on to some further clues of what's going on out there. Crypto coming off quite a bit the last 24 hours. I'm sure just like bonds, this one has caught a few people off guard as well. But again, markets are not always that easy. They see things coming. That's why Bitcoin was already ripping coming into this, and did actually continue ripping for a few months after the election. We're coming in 2025, super hot consensus. We're on our way to 250,000, which still could happen this year if markets do indeed recover. High correlation with tech stocks. However, we haven't really heard any significant new policies for crypto. There's kind of working groups doing studies. We don't officially have a strategic national reserve yet. We also just got news on Friday, the largest hack ever. And just looking at the daily on Bitcoin, it did lose that support at 89.5 here today. But just going down to a 15-minute chart. May have been a little bit of a buy the dip there. And on Ethereum as well, key support zone. This big wick we got a few weeks back has been an area where the market has found support in the past, around 2350 there. But looking a bit worse is the Bitcoin proxies. MicroStrategy down another 11.4% today, and even Coinbase getting caught up in this kind of pullback in growth stocks, momentum stocks, for which we're getting a little bit of a bounce after hours as I speak. But like I said, the numbers, guidance, and language coming out of Nvidia tomorrow night could very well set the pace. Then we go into PCE inflation on Friday. Those two things coming good. We could set up for a pretty good buy the dip, recovery and bounce. Bitcoin starts pushing back up to all-time highs. However, like I said, earnings can often be a crapshoot. Even if numbers coming good along with guidance, the market can do a completely different thing. It can whip around after hours. It can gap down, fake out, turn around, do a big bullish engulfing candle. So really anything can happen coming out of earnings, and the market may wobble a little bit going into that. But what would really help this market is if inflation did come in soft on Friday. If we did get a further dip from Nvidia, good inflation could help us find a floor here. But for the here and now, leveraged traders and those that hang on to every daily candle, no doubt getting shaken out as we see high beta assets have a sharp pullback. Even got crude coming off as well, as potentially even commodities getting nervous about tariffs. As markets and investors haven't really experienced tariffs on a global level of potentially this magnitude that we're going to get, or at least the headlines. It's no surprise to see the uncertainty. Definitely some hot money coming out of the trades that have been working well of late. But if and when those things calm down, like I said, just sets up fertile ground to buy that dip before we get that inevitable bounce. And there's a look at crude, just below $70 a barrel. We've got that big support zone around 67, 65.50. Got tested a lot late last year. And gold still just hovering around below $3,000 an ounce. Also seen a little bit of a pullback in Chinese shares, but not as much as their American counterparts. And in fact, got some international indices actually doing well today. But let's just wait and see the numbers and guidance we get from Nvidia tomorrow night, along with the market's initial reaction and how we trade in Thursday regular trading going into Friday morning, PCE inflation. May still have a few wobbles until then. Otherwise, like I said, my S&P 500 oscillator did get into oversold territory today. We didn't close there like in some previous deep dips we've had. Did get oversold there on the 13th in the morning, and we came close a few other dips as well. But on the off chance Nvidia does miss, guide down some other worries, that could set us up for another 5th of August. style gap down. However, at this stage, I think the odds are that they do beat, they do guide up, and the market may be volatile at first. However, Thursday could hold potential for a bit of a turnaround, but with some restraint going into PCE Friday. That's all for today. Thanks very much for tuning in, and make sure you come back to Click Capital tomorrow night for Nvidia's earnings. Cheers.